When will the housing market bottom? I'm sure this is a question everyone is asking in Toronto. Or maybe not, since many of us are trying to enjoy the last few moments of the summer by staying outside and not wanting to think about the real estate. However, there are many others that are probably trying to craft the opportunity to find deals. If you are curious, stick around right after this. Hello there, welcome back to AV Team Real Estate channel. I'm Antonio, your local real estate agent in the GTA. If you find any of this content informative, please hit the like button and consider subscribing to our channel so that you won't miss any of our weekly videos. In addition, if you feel like chatting with me or have any questions about the real estate market, feel free to book a call with me using the first link in the description below, or simply call us or text us with this number and I will gladly get back to you. In all honesty, no one knows when the Toronto housing market will stabilize or bottom. At least we could agree that most of the time the banks and analytics were wrong or not accurate. There are far too many variables that it is impossible to time it. However, we can almost certainly expect another increase in interest rate hike in the September announcement to combat the inflation, which has yet to reach a desirable level. Since the interest rate increase, the market has already effectively frozen. So it is not surprising the prices have drastically decreased in some area of the market. Many buyers are sitting on the sideline because they don't know how much lower it can get. Here is an example of a semi-detached home in Richmond Hills, Rougewood area that I'm looking for my client. From the past 6 months, we have seen that the peak price was in the 1.5 million range during the March and early April. And the most recent sales in June and July were close to 1.25 million. This would be a roughly 16% drop from the peak. It is very important to look at the prices and comparable in a micro perspective to understand your area. Although the client heard the news that the market had at least dropped 25% or more, that doesn't apply to a pocket of the market where he is really interested. Therefore, it is vital to work with a real estate agent that can provide you with actual data so that you can understand the market better. Then this question floats again from the client, asking when we could see the bottom of the market. And I was thinking for a while, but my sincere answer is that it could still go lower, as I already stated that most likely we are going to have another rate hike announcement. But at the same time, I find that it is very situational, since my client needs to find a place now for his family. He just recently immigrated to Canada from overseas, and if he could have waited for another few months or even years, I think he could possibly get a better deal, but unfortunately he couldn't. However, if you are looking at it from another perspective, this property is not a short-term investment for my client, and he is looking to live there for respectable 10 or more years with his family. That means in 10 or more years time, it will really not matter much if the property goes lower or higher, but in a conservative analysis, we always see an upward trend in the Toronto real estate market in the long term. The bottom line is that it is difficult to time the market to buy at the lowest price, and besides, he needs the property now for his newly immigrated family. It will be a totally different story if he's looking to sell in a short term, hoping for a quick profit. Most importantly, doing the research and getting to deep dive and understand the market, not only for this client that is looking in Richmond Hill, but also for another client in the pocket of downtown Toronto. Things are starting to pick up more traction. There are 3 key areas that I usually look at to see the current trend in the real estate market. The one area I will look at is the new listings in the area. As an example, in Richmond Hill, the listings were actually down in the July data. And when the number of new listings is declining, it typically indicates that the sellers are no longer interested in selling, since they have read news headlines suggesting that the market is not in their favor. There are few options available as inventory decreases and fewer homes enter the market. Prices will stop dropping after inventory declines to a certain level, at which point it will match the level of demand for what's in the current market. The next area I will look at is the absorption rate, which is calculated by taking the total number of sales at the end of the given time period, in this case a calendar month, and dividing it by the number of active listings available during the same period. The higher the ratio, the more demand for the property and the more opportunity a seller will have to attract a higher price for the home for sale. A lower ratio indicates slower sales and the potential for falling house prices. And finally, a balanced market is when supply of housing meets the demand from potential buyers. In your region, at least where I sell real estate, the absorption rate in February was about 80 to 90% of houses sold in that 30-day period, compared to today's closer to 25 to 33%. I believe it is now obvious that if rates do increase in September, you will also see a reduction in price because buyers' affordability is also declining. And if you look at where prices have decreased but rates have increased in terms of monthly payments, they haven't even caught up yet. Even a lower purchasing price is still more expensive. But even if you now have a greater monthly payment, I still think it is better to purchase a home at a lower price, since you could benefit if the Fed decides to ease up interest rate once they have successfully tackled the inflation. The last data point I want you to look at is what we refer to as month of inventory, which is measured by the number of active listings in the month divided by the number of sales. If the number is under 3, it is usually a seller's market when there is limited inventory. If the number is between 4 and 6, the market will be balanced. If it is over 6, the market will be a buyer's market and prices will continue to decline since there is little demand and plenty of supply. Technically speaking, we are still over 3, which feels more like the buyer's market than the balanced market at this time. And again, if you ask me when the bottom of the market will be, like I said earlier, most likely lower, and quite frankly, I really don't know. But based on the 3 indicators earlier, the trend could break out once the buyers are back from the summertime and get used to the interest rate. Depending on what you're trying to accomplish, I would say that this is an excellent chance if you are a move-up buyer right now. If you are a cash buyer, like a client that I'm working with right now, this is the best opportunity that didn't exist previously. It was the best time to find deals, and you have more negotiating power over the sellers, possibly more price reductions. And the rental market is still on fire because it's pushing all those will-be first-time home buyers back in the rental market, and many investors could be looking to enter the market again simply because they could get better rentals to cover that cost. Any person can find themselves in a wide range of situations and scenarios depending on their conditions and stage of life. There is distinct situation in the real estate market where your micro market is located, since certain markets haven't seen a price decrease while other markets in suburbs have had a significant one. I love to hear your thoughts on when you think the market will bottom, and please comment down below. And if you like the video, don't forget to hit the like button and consider subscribing to our channel so that you won't miss any of our weekly videos that we put out. I hope you have a wonderful day, and I'll see you in the next video. Bye.